Okay, so the next thing we're going to talk about is 401k profit sharing with a cash balance plan. Now, in order to implement these type of plans, what you're really doing is you're implementing 3 separate retirement plans in your practice. But if you meet the criteria, this could be a game changer, especially for an older dentist, a dentist that has been in practice a long time. It gives you an opportunity to play catch up with your retirement savings. You really need to have a successful practice. You got to be bringing in a lot of money. You got to be showing a big profit. And right now you're probably paying a lot more in tax than you need to. So how does it work? Simple as this. You're going to set up a 401k with profit sharing, and you're going to add a third plan called a cash balance plan. So as an example, when you combine the 3, a 62-year-old, for example, in 2022, 62-year-old dentist could potentially contribute $67,500 to their 401k profit sharing plan. Okay, this assumes $6,500 catch up because they're over the age of 55. So that gives you the opportunity to put away $67,500. Again, the 401k portion, if you want, you can make that a Roth. But in addition to that, the cash balance plan, that's what's called a defined benefit plan. That you could put away as much as $300,000 per year above and beyond that. I've had dentists put away $500,000 in 1 year because you could overfund it and still get the deduction, but over a period of time, there's a limit to what you could put into a defined benefit plan. So in a year where the dentist is making the big bucks, they had a really good, strong year, we're definitely going to max out that cash balance plan contribution. A year where maybe the practice didn't do as well, you don't have to put anything into the cash balance plan. So this is an illustration of how this would work. So the first step would be, if you're not sure you're implementing the right retirement plan right now in your practice, what are you going to do? Well, I'm going to encourage you to give me a call. I'm going to have one of my staff members work with you to gather all of your employee census information, things such as how much does everybody get paid, what are their ages, how long have they been working with you. Once I have all that information, I could work with one of my plan actuaries, and we could custom design a plan that's going to meet your needs. In this particular situation, we created this plan for a client, and the dentist happened to be 55 years old. The spouse, who also worked in the practice, is 53 years old. The rest of the staff was pretty young, and also in addition to that, they weren't making the big bucks, right? Looks like the highest paid person there, other than the dentist himself, was the wife, which was $60,000. So in this example, you have to give them money towards their 401k plan, right, and profit sharing plan. If you're looking at the chart there, you'll see the dentist himself got $67,500, and he was able to get $240,000 contributed to his cash balance plan. He got a total tax deduction of $307,500. The wife got $30,600, total of $31,008. He did have to contribute money for his employees, but it really wasn't that much money. At the end of the day, out of the full $346,600, the dentist and the dentist's spouse got 98% of the benefit from this. This is a game changer. It really is a big deal. So yes, you do have to give your employees some of the benefits. In this case, eligible employees got 8% because they got 6% in profit sharing, 2% in cash balance contributions. But that's okay. It's all right to give your employees an incentive to do better, work harder by giving them some profit sharing in your practice. That money is money they'll greatly appreciate. But in addition to that, it helps build loyalty with your employees. In this world today where it's hard to hire good staff, and then when you have good staff, it's hard to keep them, well, giving them a benefit like this could definitely be a game changer. It might give them a reason to stay because they're going to say, you know what, maybe they do care about me. Maybe they do want to look out for my best interest. So after you give your employees a copy of my book, right, for the holidays, and you encourage them to save 10% or more per year of their income, you're now going to give them the tools to do it, because you're also going to contribute 8% of whatever you're paying them towards their future point X for them as well. It's something that would be greatly appreciated. So this is a great example. Generally, if the numbers come out where the dentist himself and the spouse together are getting at least 78% of the benefit, I think it's something you definitely want to take advantage of. This example is a little too good. It's 98% of the benefit, but even if you're getting 78 or 80% of the benefit, I would still encourage you to do it. Another special thing about setting up the profit sharing and cash balance plan, the way we do it is with the profit sharing, we have what's called a 7-year vesting period. What does that mean? Well, the 6% contribution you're giving to your employee, if they leave right after you give them that contribution, guess what? They don't get to take that money with them, because the way it works is the first 2 years, no vesting at all. And after the third year, 20% of it is vested. The next year, 40%. After 7 years, they become fully vested. Now, why do we set it up that way? We set it up that way because we want to reward loyal employees, right? We also want to give them a reason to stay. If there's not enough reason, that might keep them there, because they know the longer they stay, they're going to get all this money. And if you're going to reward somebody, you might as well reward the employees that are committed to staying with you, helping you build your practice. So it's a great way to set up a profit sharing plan. And if for those employees that leave and are not vested, the money you allocated to them, it gets forfeited by the employee. That money gets paid back to the practice, and the practice could use that to fund future profit sharing contributions. Cash balance plan works in a similar way, but it's a 2-year cliff. And what that means is somebody worked for you for less than 2 years, even though you allocated 2% to them, they get 0. After the 2-year period, they're fully vested in that 2% you gave them. So again, these are all ways to motivate your employees, keep them with you, reward them for good work and loyalty, and in the meantime, you're getting a huge tax break out of it as well.